You know that feeling. The chart is exploding upward. Green candles are stacking on top of each other like a rocket breaking through the clouds. Crypto Twitter is screaming. YouTube thumbnails are flashing six-figure predictions. Your phone won't stop buzzing. Everyone seems to be making money except you. And then it happens. You buy. Not because you planned the trade, not because it fits your strategy, not because your risk management says it's a good opportunity. You buy because the emotional pressure becomes unbearable. And almost immediately after you enter, the market turns. The candle that looked unstoppable suddenly loses momentum. Buyers disappear. Selling begins. Your unrealized profit vanishes before it even had a chance to exist. You stare at the screen wondering how it's possible. How is it that every time you finally pull the trigger, the market seems to know? How is it that you always buy the top? Sounds familiar, doesn't it? The painful truth is that most traders think FOMO is simply the fear of missing out. It's not. FOMO is far darker than that. FOMO is the market's ability to temporarily hijack your decision-making process and replace logic with emotional survival instincts. And if you don't understand how that mechanism works, you'll continue donating money to traders who do. Think back to your worst trade. Not the one that lost money, the one that haunted you. The one where you knew better. The one where your strategy told you not to enter. The one where every rule in your trading plan was screaming, "Stay away." Yet somehow, you clicked buy anyway. Why? Because your brain wasn't responding to price. It was responding to social proof. Humans evolved in tribes. For hundreds of thousands of years, being separated from the group often meant death. Your nervous system still carries that ancient programming. When everybody appears to be making money and you're standing on the sidelines, your brain interprets that situation as a threat. Not a financial threat, a survival threat. That's why FOMO feels physical. You can literally feel your chest tighten, your breathing becomes shallow, your thoughts start racing, your attention narrows. The market becomes the only thing you can think about. You tell yourself you're analyzing. You're not. You're rationalizing. There's a difference. Analysis searches for truth. Rationalization searches for permission. And FOMO traders spend most of their time looking for permission. They scroll endlessly until they find the bullish tweet they wanted to see. They watch another video predicting higher prices. They read another thread, another post, another opinion. Not because they need information, because they need emotional validation. Meanwhile, something fascinating is happening behind the scenes. The institutions already know this. The whales already know this. The large players understand that retail traders are highly predictable during emotionally charged market conditions. Think about what creates maximum excitement. A breakout, a sudden vertical move, a powerful rally that looks like it will never stop. Now think about where most retail traders enter. Exactly, at the point of maximum excitement. At the point where social media engagement reaches its peak. At the point where news coverage becomes overwhelmingly bullish. At the point where everyone suddenly becomes a genius. And that's not a coincidence, because markets are auction systems. Prices move where liquidity exists. And where does liquidity appear? Where emotional traders place their orders. Imagine you're managing hundreds of millions of dollars. You can't enter or exit positions the same way a retail trader can. You need liquidity. You need buyers. You need eager participants willing to take the other side of your trade. So what happens when price starts accelerating upward? Retail attention arrives. Greed arrives. FOMO arrives. And suddenly the market is flooded with willing buyers. The perfect environment for larger players to distribute positions. This is why some of the most beautiful breakouts become the most devastating traps. The market doesn't need to trick everyone. It only needs to attract enough emotional participation. And emotional participation is exactly what FOMO creates. Have you ever noticed how confident you feel right before a bad trade? That's another psychological trap. People assume confidence means they're making a good decision. In reality, confidence often peaks when risk is highest. Because confidence is heavily influenced by recent price action. When price has been rising aggressively for days or weeks, Your brain begins projecting that movement into the future. You stop seeing possibilities. You start seeing certainty. And certainty is dangerous. The market punishes certainty more brutally than ignorance. At least ignorance knows it doesn't know. Certainty believes it knows. That's why FOMO traders often increase position size at exactly the wrong moment. They aren't just entering late, they're entering late with maximum conviction. The market has spent days building emotional pressure. By the time they enter, their confidence feels unshakable. Then the reversal begins. At first, it's small, a red candle, nothing unusual, then another. The excitement starts fading, the certainty starts cracking. A strange feeling appears in your stomach. You've felt it before. That uncomfortable sensation that whispers, something isn't right. But now another psychological force takes over. Hope. Hope is one of the most expensive emotions in trading, because hope convinces you to hold a position long after the evidence has changed. You don't want to admit the truth, not yet. You tell yourself it's just a pullback, a healthy correction, a temporary pause. After all, everybody online is still bullish. The influencers are still bullish. The experts are still bullish. The comments are still bullish. So you wait, and the market keeps falling. Then fear arrives. Not the fear of missing out, the fear of losing. And what's fascinating is that both emotions are actually connected. FOMO and panic are psychological twins. They simply appear at different stages of the cycle. FOMO makes you buy too late. Fear makes you sell too late. One enters at emotional extremes, the other exits at emotional extremes. Together, they create the perfect recipe for destruction. Buy high, sell low, repeat. Now here's where things become truly uncomfortable. The market isn't causing these emotions. The market is revealing them. Read that again. The chart isn't creating greed. The chart is exposing greed that already exists inside you. The chart isn't creating impatience. It's exposing impatience. It's exposing the need to be right, the need to catch every move, the need to prove yourself, the need to make back losses quickly. That's why two traders can look at the exact same chart and see completely different opportunities. One sees danger, the other sees opportunity. One sees an emotional crowd, the other becomes part of the emotional crowd. The chart didn't change, the psychology did. Professional traders understand something most retail traders never fully grasp. The best trades often feel uncomfortable. Think about that. If everybody loves a trade, where is the edge? If everybody sees the opportunity, how can the opportunity still be exceptional? Markets reward independent thinking, not rebellious thinking, not contrarian thinking for the sake of being different. Independent thinking. The ability to evaluate information without becoming emotionally infected by the crowd. And that's harder than most people realize, because emotions spread through markets like wildfire. Excitement is contagious, panic is contagious, greed is contagious, fear is contagious. Spend enough time consuming emotionally charged content during a rally, and you'll eventually start feeling what the crowd feels. And once you're feeling what the crowd feels, you're likely to do what the crowd does. That's why some of the best traders deliberately reduce noise during critical market periods. They understand that protecting their psychology is just as important as protecting their capital, because every trading decision begins as a psychological decision. Long before money is won or lost, the battle is already happening inside your mind. The trader who conquers that battlefield gains an enormous advantage. So how do you break the cycle? How do you stop buying tops? The answer isn't finding a better indicator. It isn't finding a secret strategy. It isn't finding a magical entry signal. The solution begins with recognizing FOMO for what it really is. A signal. Not a signal to buy, a signal to pause. The moment you feel overwhelming urgency, something powerful becomes available. Awareness. When you feel that intense pressure to enter immediately, ask yourself a simple question. Why now? Why this exact candle? Why this exact moment? Why wasn't I interested 3 days ago? Why wasn't I interested before the breakout? Why wasn't I interested when risk was lower? Those questions force your emotional brain to hand control back to your rational brain, and that's where good decisions live. The truth is that great traders rarely chase. They wait. They observe. They allow opportunities to come to them. They understand that markets produce endless opportunities. There will always be another setup, another breakout, another trend, another rally, another trade. But there is only one trading account, and protecting that account requires emotional discipline that most people never develop. The irony is that the moment you stop needing every trade, your performance begins improving. The moment you stop chasing every move, opportunities become easier to see. The moment you stop fearing missed opportunities, you start finding better ones. Because the market has a strange way of rewarding patience while punishing desperation. And FOMO is desperation disguised as opportunity. The next time you see that massive green candle racing toward the sky, pay attention to what's happening inside your mind. Listen carefully. Can you hear the voice saying you're running out of time? Can you feel the pressure building? Can you sense the urgency? Good. That's the moment that matters. That's the moment separating amateurs from professionals. Because professionals understand a secret that most traders spend years learning the hard way. The strongest urge to buy is often the strongest reason to wait. And once you truly understand that, once you feel it in your bones, once you recognize how your emotions are being used against you by the crowd, by the algorithms, by the market structure itself, you'll start seeing every rally differently. Not as an invitation, not as a guarantee, not as a ticket to instant riches, but as a psychological test. And the traders who pass that test aren't necessarily smarter. They're simply the ones who learned that mastering the market begins with mastering the person staring back at them from the screen.